Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's October 2025, and I want to talk this month about concerns about losses in credit markets. There's been a bit of a fuss about these, with the fear being that they're the prelude to a downturn in the economy, and that by implication, policymakers should worry about these losses. I'm going to argue in this video that that is not the case. However, I will point out one particular kind of loss which does matter to monetary policymakers. Okay, so let's just start off by recalling some recent headlines. In the last 20 or so years, there's been a boom in so-called markets in private credit. This is markets that have involved company borrowing, but they aren't in the form of bonds in quoted markets, capital markets, and they're not bank loans either. They're kind of unquoted private, but they're borrowings by companies. Now, there have been two defaults in the last few months in the USA. One is with an auto lender called Tricolor, and another one in a car component company called First Brands. And Jamie Dimon, who is the doyen, I suppose, of modern day banking, a very prestigious figure in financial circles, has said that these two situations are cockroaches. They're sort of hidden under the carpet, situations of potential trouble which may spread and imply perhaps wider losses that could perhaps affect the banking system. It turns out that JP Morgan itself, where Dimon is the boss, has lost $170 million on one of these situations. Now, what's wrong about losses? In a capitalist economy, people invest in all sorts of things, and sometimes there are profits. In general, there are profits, and sometimes there are losses. And the losses serve an important function. They are punishment for bad, incompetent, and lazy management. So bad, lazy, and incompetent management doesn't last very long. And then secondly, they give a signal that if a particular part of the economy is making recurrent losses, then capital should go elsewhere. And so this is a signal to better resource allocation. What's wrong with the occasional reporting of losses in certain sectors? Why should Jamie Dimon be worried about what's happened in the last few weeks and months? Now, let me first of all just make clear that I don't deny that if you get, for the economy as a whole, say, a big fall in profitability, heavy losses on stock markets or whatever, then this matters to the macroeconomic situation. Of course it does. But that's not really what we're talking about here. What we're talking about, it seems to me, is some rather specific losses, which aren't representative of the economy as a whole. They may be large relative to the amount of money invested, large relative to one sector of the economy, but that's the kind of loss that Jamie Dimon seems to be concerned about. And in my view, we should be clear that this is something that we shouldn't be worried about. And I'm going to consider various different kinds of loss that we see in a market economy to explain my position more clearly. We have two kinds of loss that seems to me Jamie Dimon's strictures simply don't apply. There are gambling losses. These are zero-sum situations where some people place bets on an outcome, some people place an opposite bet, Obviously, there is a binary kind of these binary situations. There are winners and losers. And sometimes, of course, losses can be large and tragic for certain individuals. But this has got, these gambling losses, that they are part of what some people do. And despite the fact that they may give some fun to people who participate in these activities, exhilaration when they win and despair when they lose, these are not losses, surely, that governments and policymakers should worry about. The same thing is true of insurance losses. We know there are going to be typhoons and hurricanes, and every now and again there's going to be a bad it's going to be a volcanic explosion or a flood or something. We know that. We can't predict exactly. Insurance premiums are paid and they protect those who are most at risk. The patterns of the loss give business opportunities. Insurance losses surely are not something that policymakers should get themselves concerned with. Having said that, if a large insurance company has such heavy losses that it goes bust, this may be a wider concern. But we don't, in fact, protect primary insurers from the failure of reinsurance companies. That's not something that public policy does, rightly so. And again, it seems to me that insurance losses aren't something to be concerned with. So we come back to, if you like, kind of more routine losses occurring in the course of business. These are losses, operating losses, where revenues don't match costs. Of course, businesses carry on in being when that is true, as long as the revenue is covering the variable costs. If the fixed costs aren't being covered, the production carries on for some time. So there's also losses, of course, because of changes in asset values. Some companies buy shares or assets at too high a price and then can't get that money back, and they make losses. Now, both of those seems to me not necessarily of any concern to society as a whole. So I've gone through these different kinds of loss, which are just seem to be part of the market economy, part of capitalism. What is Jamie Dimon wittering on about? Well, I think there is one particular kind of loss that, in fact, is of concern to monetary policy makers, and we need to be very careful in understanding what that kind of loss is before we starting to express concern and anguish about the situation. In the early 1930s, particularly in the United States, share prices, land prices, other asset prices fell heavily. And this hit the banks in a way that hadn't been foreseen in the prosperous period of the Roaring '20s. And there was a brilliant article by John Maynard Keynes in January 1932, which actually appeared in not in an economics journal, but in a magazine, Vanity Fair. He pointed out that when banks lend, they normally take collateral. They take collateral to a higher value than the value of the loan. So if the borrower doesn't repay, they can sell the collateral and get their money back. The problem with this is, what happens if the value of the collateral falls? And the falls in share prices, land prices, and so on in the early 1930s were so large that the value of banks' collateral for their loans collapsed. Banks had loan losses. The loan loss exceeded what operating profits they had from charging high interest on their loans, and they lost some capital. If they lose some capital and they're required to keep their assets at a stable ratio to their capital, then the assets have to go down. But banks' assets are the one side of banks' balance sheet. On the other side are banks' deposits. Deposits are money. So the fall in asset prices hits banks' collateral, causes a reduction in banks' capital, then causes a fall in the quantity of money. And that affects the economy. And in the early 1930s, sadly, in the USA, it led to the Great Depression. So this kind of losses on banks' loan books, so large as to affect profitability in a drastic way and perhaps to erode banks' capital, is important to policy, is important to monetary policy in particular, is important to society, so on. And if this is what Jamie Dimon is worried about, he's conceded that one of these situations, JP Morgan somehow lost $170 million, then one can see what he's talking about. Can I just say before I move on that private credit markets were supposed not to be where banks were making the loans. They were supposed to be separate from banks, but plainly banks have been dabbling a bit. Okay, well, let's just take this forward a bit more, just so that we can explain exactly what's going on and just how dangerous this can become. See, the risk is that the process of contraction of the banking system becomes self-reinforcing and cumulative. So you get a first round of the wiping out fallen asset prices, wiping out of banks' capital, shrink of banks' balance sheets, another fall in asset values, more loan losses, more loss of banks' capital, more shrinkage of balance sheets, more destruction of money. The process is potentially self-reinforcing, accumulative. And this was noticed, again, in a brilliant article at the time by a chap called Irving Fisher in October 1933, this time in an academic journal, Econometrica, and he called this the debt deflation theory of Great Depressions. Now look, this kind of loss does matter to monetary policy. We do need to look at this kind of thing all the time, and I quite concede that if what's happened in private credit markets in the last few years is the background to, again, enormous losses of this sort, then we should be worried. But I just simply can't credit this. I just can't credit it. First of all, let's just be clear that in the USA, which is really what we're talking about here, at the moment, the rate of write-off on banks' loan books is tiny. It's about 0.5% of those loan books. This isn't like 2007 and 8 and 9. You can see there when the figure moved up to about 3%. It isn't even like what happened in the early 1990s. So, we're not in 1929 to 33. And it seems to me to be hysterical and out of proportion, frankly, Mr. Dimon, to be thinking in these terms at the moment. I don't think he is particularly, but there we are. Private credit market is said to be worth about $3,000 billion, $3 trillion. That's small compared with banking systems. Even if there are other situations, like corporate situations, like Tricolor and First Brands, I don't see how the failures can be of such an extent as to cause a wider macroeconomic systemic issue. So I'll conclude by saying that in any of these discussions about losses, the occasional excitements that this gives to headline writers in the financial press, that it's really one particular kind of loss which can matter to policymakers. It was certainly very important in the early 1930s, but we're not living in the early 1930s. Nothing on the scale of that sort of calamity is to be expected in the next few months or years. Thank you.